this is Ken Goldberg, and welcome to another DSC training module. Today we're going to talk about how we use divergences in setting up and monitoring trades. This chart happens to be the chart of silver futures, but it doesn't really matter because they all work the same way. What we're looking for is a change in behavior. So for instance, if you notice how we've highlighted these lower highs, falling tops. This is the definition of a downtrend. And the reason that I highlighted in green is just so I can teach my brain when the definition of a downtrend or lower highs breaks, that's something different. And at some point here in the middle of the chart in July, the angle of the falling tops or lower highs got even steeper. So I wanted to note that, which again, when that price behavior comes back up through this steeper falling highs trend line, that's a change in behavior. Below the price bars, I use red lines because these are defining the selling. So here's the line that's defining this trend in selling. And at some point, we get this huge bounce. It's a fake out. We come down and we barely take out the low in price. And then we bounce and we barely take out the low again in price. That's much different than in the left side of the chart. As we come down, we're dramatically taking out the lows. So when this first red lower lows line becomes less steep and starts to soften its angle, it's still making lower lows, we're still in the downtrend, but now we go to yellow alert. We're looking for a change in direction. At the same time, these lower lows trend line starts to get less steep, this lower highs trend line gets steeper. And that creates this apexing effect where we're coming into this area of decision and we're either going to break out or break down, break up or break down. So what we're then looking for, and we actually kind of get it in a way, is we start to see the final low not take out the previous low. And that creates, instead of a softening lower lows line, it actually creates the first higher lows line. If you notice the angle of this blue line, it's not flat, it's actually rising. And then we get a lift. And then we come down and we attach that low with the next low. And now we're getting a steeper higher lows line. And then we keep doing that until we start to see an even steeper higher lows line. And pretty soon, not only are we getting higher lows, we're getting higher highs on the reversal. And so this divergence in sentiment and price is what puts us on yellow alert. Again, to review from the upper left to the middle, we're getting lower lows and lower highs. Pretty soon, the lower lows starts to lessen in its extreme. That tells us that buyers are coming in earlier. Yet, as the market bounces, sellers are also coming in earlier. So this becomes an area of anxiety and indecision. And pretty soon, one of the two crowds, either the buyers or the sellers, is going to take control of the baton. From the upper left to the middle of the chart, the sellers have had control. This is a seller-controlled trend. It's down. Lower highs, lower lows. So we're looking for the baton to be passed to the buyers, in which case we're going to get higher lows and higher highs. And I use the colors, you don't have to, but I do. I've been doing it for 30 years because I want to teach my brain that there's a different action that's appropriate when price bars are breaking red lines than when price bars are breaking green lines. And the reason that I want to teach my brain that is that sometimes emotion takes over and we do the wrong thing at the wrong time. And then we get to say, oh, I knew I shouldn't have done that, or I knew I was looking for this, or I should have done that, or I could have done that. And we end up shooting all over ourselves rather than teaching our brain with cause and effect. The cause of breaking a selling red line is more selling. The cause and effect of breaking a green buying line is more buying. And so we just try and keep it simple. And then as the trend changes, we use these arrows to remind us that the trend has changed. No longer a downtrend defined by lower lows and lower highs. Now it's an uptrend defined by higher lows and higher highs. Now another divergence is created in the stochastics study at the bottom. Notice how this is the angle of the lower highs in stochastics. It might be hard to see, but this is not a flat line, this is a declining line. And then pretty soon we see that that line, if we take it out, has also been broken. So it did stop on the way up, but unlike the other two times in this example, it came back a little bit and then it shot straight through it. So this is a difference in behavior than the behavior during the declining part of the chart. So all these things come together to tell us that underlying sentiment, the baton, is about to diverge from these lessening lower lows and steepening lower highs. So this is telling us that this move up here is probably not going to be one of these little moves. Not that this move was small, but it wasn't giving, although it gave us a higher high in stochastics, it only matched, at this time, the downtrend line. It reversed right from the downtrend line. So that was a different case than this latest case here, which I'll put in this yellow box. This is different. What's different about it? Well, we had a higher low in price after a lessening angle of selling. Pretty soon we started to break through and did the most steep declining tops line, and then we broke through the biggest declining tops line that goes all the way back to the beginning of the chart. And this tells us that sentiment is diverging from price and something has changed. The next thing we want to look for is on the correction that's coming down now in silver, which I'm going to draw in these blue arrows. Not only do we want to see a much higher low in price, but we want to see a higher low in stochastics. Ideally, we'd like to see that. On the other hand, even if we see a higher low in price coming down into this 15 level, even if we were to see a matching or lower low in stochastics, that would be a divergence of a different type. That's actually called a bullish divergence bisignal. And those are the 2 or 3 types of divergences that we're going to look for, because the DSE's algorithm is programmed to look for all the different types of divergences and probability rank which one is occurring according to which other components of the DSE are also pointing in either a new direction or not. And when those multiple components of the DSE affirm each other, and we get a confidence factor of 80%, where 80% of the components are pointing in one direction, then we start to talk about trade setup, which will be a different module in our video series. So thanks again for joining us. This is Ken Goldberg with DSCTrading.com and DSC Trading Chat Room. Join us in the room. That's where the stuff really happens.